If you have a home office that meets the requirements to take a home office deduction, it might seem like a no-brainer to take that deduction, right? Be forewarned, a home office deduction is not always in your best interest. There are many variables that you need to consider before taking this deduction, including one big one that nailed me this year. Watch through to the end to find out what that one was and how to avoid it. Trust me, it's a perfect example of why I wish I had been working with an accountant on a year-round tax strategy from the start. The home office deduction can result in major tax savings depending on the value of your home and the size of your home office. Claiming a legitimate home office deduction is not cheating on your taxes, but there are definitely some things to keep in mind while you evaluate taking that home office deduction on your income taxes. When considering the deduction, it matters whether you work for a company or are self-employed. Different rules apply to work from home situations than independent contractors. If you are an employee who works from home, you're not eligible for a home office deduction. However, if you're an employee of a company who also has a side hustle selling items online, you're a small business owner. You should be reporting that income and expenses, which will make you eligible for a home office deduction for the space you use to store inventory or create the items that you're selling, as long as you meet all the other criteria for the home office deduction. One important note, if your business ran a loss in a given year, you can take your share of the actual business home office expenses as a carry forward. What this means is you can carry the loss forward and take it when you do have a profit in a future year. So, for example, if you have $1,000 in home office expenses that you couldn't take in year one because you weren't profitable, you can potentially carry those losses into year two when you do become profitable. So it's not lost, it's just held off until you make a profit. Many people might think this is the worst possible scenario, and believe me, it ain't great. It's commonly believed that taking a home office deduction can possibly increase your chance of being audited. This may or may not be true today, but filing a Schedule C may increase your chance of an audit. Of course, not everyone who files a Schedule C also takes the home office deduction. To be safe, always keep good records of all business expenses, including those for your office. All right, here's the dog that bit me this year. Before you ever take a home office deduction, you need to think about the long-term possibilities. If you've been claiming a home office deduction and then you sell the house where your home office is located, it may very well affect your capital gains taxes. Depending on the sale price of your home, how long you've been claiming that home office, and how you claim it, could have a major impact. You see, the capital gains tax exclusion allowed from the sale of your primary residence could be reduced by the amount that you have claimed for depreciation on your home office. The IRS giveth and the IRS taketh away. However, if you've always used the simplified home office deduction, which was instituted in 2013, this doesn't apply. The simplified method results in a smaller deduction each year, but it doesn't involve expense tracking, so record keeping is easy. The simplified method is limited to 300 square feet, and it's currently set at $5 per square foot. The key is you have to choose the way you're going to file and stick to it each year. While the simplified method may be much easier to calculate, for the vast majority of taxpayers, the actual method will give you a far larger deduction than the simplified method. When you factor in things like depreciation, mortgage, and real estate taxes, the actual method in the majority of circumstances gives you the largest tax benefit. Now, it's true that the IRS recaptures the depreciation you took and then taxes you on that amount when you sell your home, but they only do this for the depreciation you took. They don't look at any home appreciation. The second thing is, when they recapture the depreciation amount, the tax rate is typically between 15 and 20% on capital gains. However, when you take a home office deduction, you're reducing the ordinary income instead, which generally you're paying a lot higher tax rate than 15 to 20% on. So the home office deduction can be a great way to lower your tax burden, but don't go into it without considering all the long-term effects. You know exactly what I mean, too. You sit there with your tax filing software, you click back and forth, standard option, simplified option, standard option, simplified option. And you choose whichever one has the better impact on the bottom line. And just remember, the choice you make today might come back to bite you down the road, which again is another reason why tax strategy is much smarter than tax season. Don't just do your taxes, manage your taxes. Reach out to 1-800-ACCOUNTANT today to talk to one of our experts and start working on your long-term, year-round tax strategy today. And please, as always, if you found this to be educational, informative, interesting, or entertaining, don't forget to hit like and subscribe, check the links in the description, and have a great day.